When should you consider investing in debt securities? Imagine lending money to a reliable friend, and in return, they pay you back a bit more as a reward than you initially gave to them. This is basically how debt securities work. Debt securities are like loans that you can give to a company or a government body. In return, you get fixed interest for a set period, and at the end, you get your initial loan amount back. Let us understand few terms often used in relation with debt securities. Issue date and price. The date and price at which the security is first offered. Coupon rate. A fixed interest rate paid by the issuer throughout the security's life. Maturity date. The date when the issuer must repay loan and remaining interest. Yield to maturity. The estimated return you can earn if the security is held until maturity. Debt securities can be classified into different groups based on its issuer, maturity period, and other specific factors. Starting with bonds. These are loans typically ranging from 1 to 50 years given to governments or private corporations. Corporate bonds are debt instruments issued by companies to raise funds, offering investors regular interest payments and the return of the principal at maturity. They generally provide higher returns than government bonds, but come with higher risks, such as credit or default risk. In India, however, the debt market is dominated by government bonds, which account for around 74% of the total outstanding securities. They are considered safer than corporate bonds and carry virtually no risk of default, making them popular among investors. Speaking of bonds, investors looking to buy them can now use online bond platforms. These platforms simplify the process of investing in bonds by providing a one-stop solution. Here's how you can get started. Sign up. Create an account on the platform by completing the KYC process. Browse options. Explore the available bonds categorized by issuer, maturity, yield, and credit ratings. Select bonds. Choose bonds that align with your investment goals and risk appetite. Make the payment. Complete the transaction online through net banking or UPI. Monitor investments. Track your portfolio and receive updates on your bond holdings through the platform. These platforms make it convenient for retail investors to access bonds, including government securities, corporate bonds, and tax-free bonds. Now, let's look at Treasury bills. These are government securities with maturities less than a year. T-bills do not explicitly make interest payments, but are issued at a lower price than their true value. For example, a 364-day T-bill with a par value of 100 rupees can be issued at 94 rupees. After 364 days, the T-bill holders will receive 100 rupees back, making them earn 6 rupees as a return. T-bills are considered nearly risk-free due to their short maturities and sovereign guarantee. On the other hand, commercial papers are issued by companies to fund their short-term expenses. Their maturity period can range from 7 days to a year. It is a relatively small category in debt markets, first introduced in India in 1990, but can yield higher returns than T-bills. Non-convertible debentures are another popular form of debt securities. Issued by companies to raise long-term capital, they come with fixed interest rates and cannot be converted into equity shares. NCDs often offer higher returns than traditional bonds, but also carry credit risk depending on the issuing company's financial health. Some NCDs are listed on stock exchanges, providing liquidity to investors. They are an excellent option for those seeking regular income through interest payments. While not a debt security, preference shares are a hybrid instrument that offer features of both equity and debt. Holders of preference shares receive fixed dividends before any dividend is paid to common shareholders. These shares are particularly appealing to investors who prioritize steady returns but are willing to accept slightly higher risk compared to traditional debt securities. Once issued, most debt securities can be traded on exchanges. The price of these debt securities move in opposite direction to the interest rate set by RBI. This is because when the interest rate goes up, newly issued debt securities often offer higher returns, making them more attractive for investors than existing ones with lower rates. As a result, the price of the existing debt securities typically falls as investors are willing to pay less for them. The opposite is also true. Debt securities are generally considered to carry relatively lower risk as they offer predictable returns. In comparison, equity is riskier as it has no guaranteed returns and largely depends on the performance of the company. Thus, debt securities may be a suitable choice for conservative investors looking for regular income and stability in their investment portfolio. To understand if you should invest in debt securities, consider consulting a financial advisor.
सोच कर समझ कर इन्वेस्ट कर